I'm very happy to be here. It's the first time I've been to Kiev in this very beautiful city. I'm from an organization which is London-based, but it's an international company that's dedicated to professional education and retail banking, underpinned by a professional code of conduct and ethics uniquely designed for retail bankers. And I wanted to talk to you today about the importance of culture in banking. And it's been particularly beautifully framed for us in the example of the recent Wells Fargo scandal. So I'm going to be referring to that throughout my presentation as the case study, and then we'll talk about how we can think about creating an ethical bank culture off the back of that. So, Wells Fargo is known and loved by investors for its cross-selling strategy and for its hard-selling culture. However, on the 8th of September 2016, Wells Fargo, the poster child of banks around the world, was fined $180 million because the bank's employees opened fictitious accounts to meet their sales targets and boost their sales figures. CEO John Stumpf is then called to testify before Congress. Shortly thereafter, within a week, Wells Fargo's share price collapses, losing $25 billion in value. Only yesterday, Bloomberg reported that Standard & Poor's had downgraded its credit outlook rating from stable to negative. However, in the meantime, a month prior to that, CEO John Stumpf sells $61 million worth of Wells Fargo shares prior to the fraud revelations. We believe that there will be an SEC investigation along the lines of insider trading. It's being talked about. And there he is testifying before Congress. And as you see there, he managed to unite the usually discordant Banking Senate Committee in a chorus of outrage. I don't know if you've seen the videos, but they've gone viral. So Wells Fargo is now in the very unfortunate position of being associated in the minds of consumers with appalling customer mistreatment. And public trust in this once revered bank is now shattered, as you'll see from the very interesting graffiti that's been scrawled on the side of an ATM. So let's go back to the beginning and let's look at the origins of this culture. In the 1980s, the future Wells Fargo CEO, Richard Kovacevic, read a piece of research which said that the average US household had about 16 financial products. He took this number and he divided it by 2, and he adopted this as the central target of Norwest, which then merged with Wells Fargo, and he then became CEO of that bank after the merger with Norwest. And this goal became the cornerstone on which the bank's culture was built. And this message is the same in every annual report going back 27 years. Now, you could argue that what Kovacevic put in place was a selling strategy rather than a cultural strategy, and that current problems are strategic rather than cultural. However, strategy and culture are closely linked, often because the same person puts them in place. And Kovacevic was largely responsible for both in the case of Wells Fargo. I wanted to show you a quick analysis of the bank annual reports, which shows you the frequency of the appearance of the word cross-sell. And you'll see there it goes back to 1998, which is pre-Wells Fargo. And then onwards, you can see it really accelerates and intensifies from 2004 onwards and hits a peak in 2014. So the Wells Fargo culture can best be described as conservative from a credit and capital point of view and aggressive from a sales point of view. On the evidence of the annual reports that you've seen, the sales targets seem to have been very much driven from the top down. And top-down sales targets were actually what caused the UK mis-selling scandals in very recent times. The bank's 2016 annual report said that 80% of our revenue growth comes from selling more products to existing customers. And the goal is to sell at least 8 products to every customer, because as CEO John Stumpf said, 8 is great. It appears that bank staff, however, experienced freedom from central control only in regard to credit decisions, and these do appear to have been quite conservative and very sensible. So much so that Wells Fargo's loan-to-deposit ratio is in the middle of the investment-type banks and the Main Street-type banks at 0.7%. And it also has a very high tangible equity-to-assets ratio by international standards. So these conservative positions tell us that Wells earns less from credit and lending that could be earned otherwise, and so the bank has turned to cross-selling to make up the difference. Another example, Wells returned 1.2% on assets in 2015, which is much higher than US Wall Street banks, and looking at the profits being earned by US Main Street banks, would be a highly profitable bank anyway, even without the hard-selling culture. Yet, Wells has put this opportunity at risk, playing a very high-stakes game to push the profits even higher and risks losing it all. Very interesting cartoon there. So this is what CEO John Stumpf himself is on record as saying about culture. If there is one job I must do for our team members, customers, communities, and shareholders, it is to be the keeper of our company's culture. It is the role of all team members to understand our culture, internalize it, live it, teach it, and reinforce it. Heroic words. The Wells scandal has provided us with a concrete and highly relevant example of the importance of bank culture, for it's first and foremost a cultural scandal, which actually betrayed the bank's customers as well as its shareholders. The management of Wells Fargo insists that employees were acting on their own initiative and dismissed over 5,000 of them. However, internally, the bank was aware that the high-pressure sales culture was leading to serious wrongdoing, because since 2011, and by its own admission, it had been firing employees who sought to boost their sales targets by opening fake customer accounts. So Wells Fargo knew that the cross-selling metrics that it was putting in its annual reports were misleading. It didn't fire all 5,300 employees last month, but over a period of 5 years. Yet the bank continued to promote these misleading numbers to investors without informing them of the fake account generation. Top executives, meanwhile, maintained that the problem originated with the low-level employees. However, employees have since come out explaining that they were coached, the frontline staff were coached to open these fake accounts and were threatened with dismissal if they failed to meet their cross-sell targets. So in an effort to survive, these frontline staff invented new business to boost their sales figures. What is more scary is that the bank's willingness to scapegoat these low-level employees is so at odds with its official values, and it's worth revisiting Stumpf's vision of culture and where it stops and starts. So what went wrong? The central sales target undoubtedly brought financial rewards to Wells Fargo shareholders over many years. And observers have been asking what went wrong to derail such a successful business model that was profitable for so many years. Our contention is that nothing went wrong, but that an overly aggressive sales target will inevitably push a bank into trouble, and it's only a matter of time. Those are very interesting numbers that I'm happy to talk you through. It's very small on the slide, but these numbers have gone viral and they're all over the internet. These are some interesting slides as well about, for instance, this one is product sales per banker per day at Wells Fargo, and you'll see that it hit its peak in 2005, an average of 5 product sales per banker per day at Wells Fargo. I don't know how this compares with your own banks, but it seems pretty high, pretty aggressive. This chart shows the percentage of customers with 8 or more products with Wells Fargo. You'll see there in 2009, it was already up at 25%. And this slide shows you the retail cross-sell ratios at Wells Fargo all the way up to 2015. It seems to have hit its natural saturation point at 6. I think it's worth taking a step back now to look at exactly what culture is. A corporate culture can be viewed as having 2 main dimensions. The first is an ethical stance, and the second is a cultural operational model. So we can think about the ethical stance as the extent to which an organization will go to exceed its minimum obligations to its stakeholders. And when I say stakeholders, I'm referring here to shareholders, society, and even the bank's own employees. And then the cultural operational model refers to how the bank's operations steer it towards that ethical stance. Now, an ethical bank culture should provide a reference against which individual actions and decisions are evaluated on a continual basis that goes far beyond formal compliance. It's rather the spirit of the law than the letter of the law. Individuals in a bank look to leadership for guidance on what is acceptable behavior, and it's up to leadership to create the right culture that empowers employees to do the right thing because it is the right thing to do, and then relentlessly communicate that across all levels, across the board, throughout the bank. So ethical individual behavior, aligned with a strong corporate bank culture, creates an ethical bank culture overall. Now, Wells Fargo has already started to address criticisms of its sales quotas and risk controls, but this is obviously more than a process problem. It's a corporate culture problem. And simply eliminating sales quotas will not magically turn fear into inspiration. It requires credible, values-based leadership to foster the right culture. And banks have continued to grapple with issues of culture since 2008, and I think Wells Fargo saw itself as being the exception to this rule. It certainly isn't. And to succeed, its repair efforts are going to have to lead with accountability from the executive suite. These efforts will probably also get a boost from external forces, as calls grow much louder for prosecutors to focus more on executives, which we've clearly seen in the case of Elizabeth Warren. Of course, this is also going to require culture change in a different set of institutions, and again, that starts from the top. So what exactly are these problems of culture? How can we zoom in on them? First of all, for us, it's important to note that banking is not retailing. It became quite fashionable in a certain period of time for retailers to take control of banks and to assume CEO positions in banks, as we saw in the case of HBOS with Andy Hornby. And that case study has many parallels with what happened at Wells Fargo. So Kovacevic started out his career at General Mills, which was a retailer in the US. And this extract from his 1994 Norwest annual report shows that the bank took pride in being compared to a retailer. Morgan Stanley calls us a retailer in banks' clothing. We agree. We are sales per square foot business. We measure our performance on the number of bank products sold per household. Now, the main difference between retailing and banking is the time difference involved. Retailers typically operate on a 3-month time horizon, while banks sign long-term agreements with their customers many times for 30 years. And it really beggars belief to think that you exploit rather than nurture a 30-year relationship with a customer. A second difference is the nature of the products involved in retail and with banking, which can best be described in this saying: banking products are bought, insurance products are sold. So the need for a banking product is present even before the customer comes into contact with a bank. The need is real, and it stems from the real economy. A retailer, by contrast, can create the need or perceive need. So if this argument is valid, it would mean that banking products are subject to a kind of saturation point. A tool of wise economists is the rule of thumb, which can tell us about the natural rhythm to which an industry or economy moves. So perhaps Wells has inadvertently invented a new rule of thumb, which says that 6 products is the upper limit on cross-selling, or the saturation point. And therefore, it's possible that Wells' recent fines are an indication that this point has been reached. The second is product development. It's very evident that Wells spent all its energies on selling rather than on developing quality products that would sell themselves. There is also evidence that product development was neglected because top managers in retail banking were in fact consultants and marketing specialists rather than bankers. The third one, which is critical, is remuneration structure. It's very clear that remuneration was linked to cross-selling central targets. But what are the alternatives? So a very good alternative to consider is from Handelsbanken, a very successful and highly profitable bank in Sweden, which introduced a profit-sharing scheme. So allocations are made to this profit-sharing scheme for all employees if the bank's profitability is better than the average of its peers. And this scheme aligns employees' interests beautifully with the bank's corporate culture and has been incredibly successful. At the other end of the scale, the trend in the UK is now to eliminate sales targets altogether. They've been abolished to a large extent. And they're now solely focused on performance measures, which are linked to customer satisfaction, people, and risk. So you won't find any of the UK banks who have remaining central sales targets. The fourth one is an excessive focus on growth and market share. The growth at all cost approach is a strategy that is more likely to engender itself to a bad culture, particularly when a bank seeks to grow more quickly than the market in which it operates. It sounds logical, but for 27 years, that was the strategy of Wells Fargo. And then finally, the CEO. One of the best studies of organizational culture is old. It's Peters and Waterman's 1982 classic, which is called In Search of Excellence. And the authors found that associated with almost every excellent company was a strong leader who seemed to have had a lot to do with making the company excellent in the first place. And these excellent companies seem to have developed cultures that had incorporated the values and the practices of their excellent leaders. And obviously this works in complete reverse for companies with poor cultures. So the CEO is critically important. So what can we do? What are our recommendations? All of these points that you see here on the slide are going to require a dramatic change in culture. And we believe that this is best delivered through a professional education program starting right up at the C-suite. So commit the bank to always act in the best interests of the customer and mean it. Commit the bank to a demanding code of conduct and ethics and publish it. Get to know your customers' real needs and make cross-buying the objective and not cross-selling. And change the management team if cross-selling is the core culture. The best place for Wells Fargo to look is Handelsbanken. And again, I come back to this, for us, is the best-in-class model. Its culture stands in polar opposite, where there are in fact no sales targets, and there's a decentralized approach, where in fact every branch manager acts like a local CEO. Wells Fargo has always defended cross-selling on the basis that customers benefit from bulk discounts and that they would be buying those products anyway, according to this alleged piece of research which says that each household has 16 products, which we are yet to find. But we believe that banks which listen to their customers' real needs have businesses that are viable in the long run. Aggressive cross-sellers can be highly profitable for the bank in the short term, but this tactic always gets the bank into serious trouble in the end, as we've now seen. And change has to start at the top. The Wells Fargo story reminds us that amazingly, unbelievably, we still live in an era where listed banks, some of the largest listed banks in the world, are still run for the management's benefit rather than the shareholders and stakeholders. So what are the conclusions? Earlier, I considered whether there might be some natural rate at which customers buy banking products. Perhaps there is a rate and perhaps there isn't, but one thing is certain, and that's that frontline employees are going to have a much better understanding of what this rate is than top management. So it seems sensible, or we could conclude, that either let these frontline staff have an input into setting these targets or abolish central targets altogether. I'm coming back to the case of Handelsbanken again. The former CEO, Dr. Jan Wallander, published a paper in 1999 entitled Budgeting an Unnecessary Evil, which gives a very useful perspective into what his motivations were when he reshaped the bank back in the 1970s. And I'll tell you what he said. It is also very important that your organization is based on a number of relatively small units, which have a considerable degree of independence and authority. In other words, that your organization is decentralized. Without this, it's very difficult for your employees to become involved in their work, to become engaged employees, which is so extremely important. Dr. Wallander's other two principal changes help to keep the ROE target working in favor of the bank, its customers, most importantly, and its shareholders. And these changes were firstly the decentralization of the bank, and secondly, the introduction of the profit-sharing scheme. So finally, how does a bank with a challenging target for profitability make sure that the target is a benign one on the organization and not a malign one? The answer, we believe, lies largely in culture. Organizations with good culture have long-term perspectives, which help enormously in ensuring that an ROE target and the pressures of low interest rates or even negative interest rates do not become wrecking balls in the future.